Hi, welcome to Financial Thought Exchange from the CFA Institute Research Foundation. I'm your host today, Larry Siegel, and we have a very exciting guest, Allison Schrager, who writes about a form of risk that we don't often study carefully, but we all know about it, which is personal risk. And as an economist trained at Columbia, uh, this is a departure for her from the main thrust of the field. Stephen Levitt has been there first, but I think Allison's work is more fun to read, and we're going to talk to her about it. She is now a fellow at the Manhattan Institute and a columnist at Bloomberg, and so rather than pursuing an academic career, she's doing something else and doing it from my experience with great enthusiasm and color. And Allison, how are you today?
I'm great. Thanks for having me.
Thanks for coming. The most famous thing that you've done is to put an old barroom joke on the cover of the book, modify it slightly, and it's called An Economist Walks Into a Brothel. What is it about?
Well, I'm glad you brought up Steve Levitt because for a while I was working sort of half in journalism, half in finance, and when I was at Dimensional Fund Advisors, I was doing a lot with retirement and working with financial advisors for the first time, and noticed that the concepts of financial risk, there weren't good ways that people had to communicate them to laymen. And obviously in my studies, I learned a lot about it. So I was thinking the market really could use, and it would be fun for me to execute on sort of like a Freakonomics, but for financial economics rather than applied micro, which is what Steve Levitt did.
Yeah.
At the time I was thinking it would be great for financial advisors if they had something they could just hand to their clients, be like, this is how you can understand what I do. And because I was speaking to them and they always had these issues like, you put me in this portfolio based on what my needs are, but my neighbor is getting more money than I am in his portfolio. Why can't I do that? And, the answer is usually, well, risk. Like, we've chosen a less risky portfolio for you, or you have different goals. So a way of thinking about it. But then when I sat down to do it, I realized, unlike Steve Levitt, I didn't have a big research portfolio of these stories. So I would have to actually go and report them myself and go to these places and talk to these people.
So give me a couple of examples of places you went and people you talked to. What did you learn, and what can we learn from those experiences that you recounted about risk?
The obvious one, obviously, is the brothel that was on the title. But I had all sorts of fun adventures. I spent time with the New York paparazzi, learning about how they have very volatile wages, how they manage their risk. I spent time with horse breeders in Kentucky, learning how a price was put on studs. And then I also went to Hawaii and went to a risk conference for big wave surfers who actually have annual risk conferences. And the thing that stuck out is, as you said in the beginning, I do a different kind of risk, which is personal risk. But really, no matter what industry you're in, we are all following the same basic principles of financial economics, which is all about putting a price on risk, valuing risk, and then finding various ways to ensure a hedge against risk. And that's honestly what everyone does. Like I said, even like a New York paparazzo who, might not have a lot of formal education is really using a lot of the same principles that we do.
I'm not sure what paparazzi do other than follow people around taking pictures, but I do know what the wave surfers do.
Yeah. Well, the paparazzi, like they have a lot of idiosyncratic risk, as you can imagine.
Yeah.
Because the odds that you see a celebrity doing something interesting at any one time is low, and somewhat random. So they form alliances where they say they're gonna share each other tips with each other. So That means less, like sort of like diversification. It might mean less upside risk, but it means more consistent income and more income on average. But these alliances they form always are very fragile because the odds of getting like a really good tip that's going to really blow out your earnings, when that happens, you have no incentive to share that information. So the alliances always fall apart. So they're sort of doomed to deal with this idiosyncratic risk.
Yeah, I mean, all alliances between competitors fall apart,
Mhm.
and and when they choose to share information, it's probably the information that they think they don't need the most. That-
Well, and by the same token, people often are swayed to invest in individual stocks and out of index funds because they're like, my buddy has a tip, or if I just go heavier in Amazon and Nvidia, I'm gonna like beat the market. So, I mean, I think we're all susceptible to this.
That's right. There isn't a day that goes by that I look at my portfolio of boring index funds, including a lot in
Mhm.
fixed income, because I'm old. I'm not. I don't know if I'm old or not, but I'm getting there, and I realize everybody I know is making more money than me.
Exactly.
That's right. And I forget who said it, but there's a saying that there's nothing that ruins your mood more than finding out that all your friends are getting rich and you're not.
Yeah, but I'm a big believer. You have a philosophy and you stick with it. And so, like you, I'm all in on the index funds.
Well, my philosophy, well, stepping back a little, what am I trying to do with all this money? Is being moderately rich is perfectly fine,
Mhm.
but losing most of the money in a market crash at 70 would be terrible. So I'm a pretty low risk profile investor. I bet you're not.
Well, I don't have it. I don't have individual stocks, but I like to spice it up with like I have my DFA experience with I do some small cap, I do some emerging markets,
Mhm.
and for me that is how I prefer to take risk. It's still in funds, but I just invest in what I see as riskier parts of the market as a fund.
Well, I have a share of a frontier market fund,
Mhm.
very small fraction of my portfolio, about 1%. And I paid a certain amount for it in 2017, and it's right back to where it was.
Yeah, actually,
Meanwhile, the S&P has gone from 2,000 to 6,000. So you're always mentally making those comparisons. And
yeah, although yeah, actually, now that you say it, I think my emerging market core fund has not done as well as my S&P 500 fund. But
nothing has.
yeah, but I'm a believer. This is for the long haul. It's for another couple decades, hopefully. So, I believe like ultimately, emerging markets should have higher returns on average because
So do
they're
I.
riskier.
Yeah, no, I agree. And rather than delve into our individual portfolios any further, we could do that in the second episode a little later. But I'm interested in your origin story. What went off in your brain to say I'm not going to do what all the other economics PhDs are doing and explore this new direction? One possible reason is just to have fun, but another I think is that you've gotten a lot of attention for your unusual research agenda.
Well,
What,
it's certainly
how did it happen?
was not the plan. I did a PhD in economics just because I was really like excited and passionate about economics and wanted to learn a lot about it. And I think while I was in grad school, I, felt like academia was what I was supposed to do. And if that didn't work out, I worked for the government. Um, so
Okay.
I kind of went along with that. But then I went on the job market and I went to all these interviews and I was like, wow, I really don't want to do any of this. Like they're great jobs and economists are very lucky to face a very good job market. But it was just I mean, I grew up in a little college town, so the idea of doing that as an adult didn't appeal to me.
Hmm.
And, whenever I was in grad school, I really felt like this is so hard. It was very difficult, but I felt like I was learning important things that I could do really interesting things with. And then when I was looking at a career in government or academia, it didn't feel like I would be doing that. Um, So, or if maybe I would eventually, but like in another 10 years. And graduate school is 6 years, and it was very unpleasant and very difficult, and I was very poor. So I didn't really want to have another 10 years of that.
No,
So
I didn't do it either.
yeah. So I really I managed to sort of blow all my interviews, and my committee was very disappointed with me. And
And you mean academic interviews?
yeah,
Okay.
and government ones too.
And
Like
government. Okay.
anything sensible. I managed to completely blow that interview because I just desperately did not want to be there. In fact, I think that was the feedback my advisor got, was she seems very unenthusiastic. Um,
Okay.
and um, so I was, starting to get near graduation, and like unlike other fields, economics is like a big deal to graduate without a job. Like everyone gets a job.
Right.
And I was a native speaking female, which is supposed to make my job prospects even better. And like I had a dissertation everyone thought was good, which made it more embarrassing for the department. And I just had no plan. And really, no one really tells you what you can do with an economics PhD that's fun. Everyone just is like, work for the government or maybe work for a bank. And I spoke to some banks, but I didn't really have good finance skills at that point. So one day I was reading The Economist, and I was like, well, at this point, I'm just like, I felt like I had nothing. Like I felt like the whole economics thing, which I'd been doing since I was 16, was just like not going to work out. Like I really felt like, well, I remember saying in my defense to my committee, well, they're like, what are you going to do? And I was like, I don't know. We teach all these MBAs, they get jobs. Maybe I could get a job. And they're like, you can't get a job. Yeah. So I remember feeling like, well, I'm at zero. So what am I going to do? And I was reading The Economist, and I was like, well, this looks like fun, and I haven't had fun in a long time. So maybe they'll let me write for them. So I wrote the New York bureau chief like a cold email, which never works. Like The Economist gets emails all the time from people saying I should write for you, and they usually throw them out. But it was 2006, and they were just sort of starting web stuff. And I think at that point, we're not particularly bothered by who wrote for the web. It was sort of like their little experiment. So they're like, we're starting this blog thing. I guess you could contribute to that if you want, because you know some stuff about economics. And so I started doing that, and it was Megan McCardle who I actually started working with.
Oh, fabulous. I really like her work.
She's great.
I haven't met her or anything, but she just has to be great.
She's lovely. And she bless her, sat me down because came from academia. I was a terrible writer. I had no idea how to connect with people as a writer. I mean, I wrote like an academic, and she like sat me down and gave me these like ministries on how to write for the public, because it's so different. So you actually have to write things that people want to read, which I'd never done before. And so I did that for several months. Most of the time was actually unpaid. I mean, he said I was desperate at the time.
Yeah.
And then someone gave my dissertation to Bob Merton, and he called me in, and he was like, what you did is really what I'm working on now. I have this startup where we're developing pension investment strategies. That's very obviously one of the foundation papers of my dissertation was his work, so it's not a surprise it was similar, because everyone who does anything in finance or risk, the foundation paper is Bob Merton's. So he's like, come work with me. I'll teach you finance. So I joined his startup, and then we were acquired by DFA, but I kept up writing with The Economist on the side. So I think that's what gave me this sort of quirky dichotomy, and where I could really go very deep and learn a lot about finance from Merton, and then later Jean Fama and Ken French, but also could explore a more creative side doing some writing, because especially the web at The Economist also was more experimental in that they kind of let you develop more of a voice and sort of explore, say, quirkier topics. So enough so, as I said, when I reached a point where I felt like I had this skill as a writer, I had this skill that I understand finance pretty deeply now, maybe I could combine the two.
That's a great story, but it only gets you to why you're a journalist and a writer of best-selling books, but not why what you write about. Personal risk is fascinating because people who take a lot of risk tend to be different from your average Joe and Jane, and you make these people come alive in your stories
Thanks.
in a way, in a way that's almost unique. John McPhee can do it. Um,
Yeah, I mean, I think it's everyone I think is a risk taker in their own
mhm.
way.
Yeah,
It's just
no,
what they're comfortable with. It's like the surfers, or for the new book I'm working on, I was talking to a tightrope walker, and like they all have like these things they do, which I think is insane. Like I won't even ski. Like, I mean, I find like physical risk terrifying. But like they all say things to me like, "Oh, I can never invest in the stock market. That's too risky. That's crazy." So I
That's
think,
right. That they're right and you're right. As I,
yeah,
more, I think maybe it was Morgan Housel said, nobody's crazy. When you see
yeah,
people doing something that looks crazy, they're operating from a different instruction set. Now, I'm not
exactly.
talking about raving madmen who go out and
Yeah.
shoot executives, but if you are if you jump out of airplanes, but you think that the S&P 500 is too risky, maybe it is because you can't stand to lose 30 or 40% of your money in a year. And for me, the S&P 500 feels safe, but you're not going to get me to jump out of an airplane, no matter what you do.
Yeah, like the tightrope walker, he comes from like multi generations of tightrope walkers. This is what they do. They hang out, they tightrope walk. They have all these techniques to manage that risk. It doesn't feel risky to them. Anyway, actually, quite a few of them have died over the years, but you know.
That is, tell me how did you meet this person and tell me what you've learned from interacting with them because most of the listeners here won't have read your book.
Well, it's also a book that's still with a publisher, so you couldn't right now. But this is for the new book. I interviewed Nick Wallenda, the Flying Wallendas.
Yeah.
They're
Yeah.
famous tightrope walking act, and they've been doing this, I think, for like 230 years. Um, but it's amazing is he's only a little older than I am, but he grew up in the circus. You know, like I didn't know people did that anymore. Um, but that also meant that, and I think this gets the difference between him and I. Well, he grew up, on a tightrope, learning how to make that as low risk as possible, as calculated as possible. The family, being circus performers, really lived hand to mouth and had incredibly
Right.
variable income. Um, so I think that's why he's very nervous about financial risk, because that was just a risk they never quite knew how to manage. They knew how to manage tightrope walking, but not their finances. And I think this is I say like people like some people are risk takers, some aren't. People would look at him and be like, clearly he's a risk taker. He actually got famous. He walked across the Niagara Falls on a tightrope. He walked across the Grand Canyon. He's done all these crazy things that to me seem utterly insane.
That's crazy. The Grand Canyon is miles and miles and miles.
I think he chose the
Fur-
narrowest, but
It goes the widest part.
narrowest part.
The narrowest part is still miles, and even if you walk across it on the ground, there's some risk. They
Yeah.
rescue people every day.
Or
How
the
did he?
Niagara Falls even more, because the biggest risk when you're tightrope walking is the wind. And
Oh yeah, right.
so the weather there is pretty bad.
How do you string a tightrope across the Grand Canyon to walk on?
I can't remember. It's been a while since I've interviewed him, but
On an airplane, probably. But
yeah.
so that's an exciting story. But it's in a book that isn't yet published. Can you tell a story that people who are listening today can read about in An Economist Walks into a Brothel?
Yeah, I mean, so another one would be, I guess, the big wave surfers.
Yeah.
Um,
Oh, I love that one because I've failed my only surfing lesson.
But I think I described how, big wave surfing is a lot like stock options. But the guy I spoke to there is Greg Long. And he is a famous big wave surfer who nearly died from drowning. And he had all these, again, they take risk very seriously. They have an actual risk conference where actually it reminded me a lot of a financial conference. They're sitting in a windowless conference room, they're looking at slides, and they're really thinking about things like idiosyncratic risk, systemic risk, like all these things. And what's interesting is the interplay between technology and risk, of how technology can enable you to take more risk, but in other ways exposes you to more risks. And he once nearly drowned, and mainly because he had all the fail safes just failed him.
Yeah, no,
You know, he had the big thing now is inflatable vests that if you fall off a wave, you pull the string and it turns into a life preserver and it buoys you up. That failed. The guy in the jet ski couldn't get to him. Um, it was just, and he nearly died, but thankfully he was still attached to his board, a leash, which is actually the most low-tech technology they use. And someone was able to find him and swoop him up, just in time. And he said how it really changed his outlook, and he really was able to surf again, but it took him a lot of time.
Hmm. What does he do to manage these risks? I mean, here you've got a 30-foot wave straight over your head coming right at you. You were too far from the ocean. I mean, you were too far out in the ocean to swim to shore easily, partly because of the waves. And so the risk management must be before that. It must be in the preparation for that situation. You know what will eventually happen. And what have you done by that point? And what do you do then
Well,
when
I
it
mean,
looks like you're going to die?
you train a lot. I mean, they're in very good shape. They practice breath techniques. They can hold their breath for up to 5 minutes.
Oh, shoot.
Um, The main thing, I mean, and honestly, a lot of the prep work is done before. They're like stock traders. They're just like on their computers all the time looking for these optimal waves. So it's not like they just like, are like, oh, it's a big wave, let's just go do it. They really are following data. I mean, they all really could be, if they applied themselves differently, be trading stocks and probably be very successful at it.
Mhm.
Um,
Okay.
because you're using mathematics. They even find that the weather models are not sufficient for their needs. They've developed their own weather models. Um, so they've done a lot of research before. And then there's little things like one of the ways he messed up, and this again, I think has a lot of lessons for all of us that day, was one of the tricks they use is, big waves tend to travel in sets. So it might be like 5 big waves after another, and then you get a bit of calmer water. Is you take later waves in the set. That way, if you fall off, there's not like 4 big waves going to be barreling on you.
I see.
And he's telling me how I asked him, like, why did you take the early wave? Because it was the first wave in a 5 wave set. And he was like, it'd been a long day and I kept waiting for the later waves, but like it would be a good wave and then it would be forced like really bad waves. So I just got frustrated and finally a good wave came along and it was the first wave. So I was just like, I'll just take it. Um,
Okay.
so he abandoned one of his risk management principles because, again, it's sort of like a friend giving you a good stock tip and diverting from index funds. You're like, forget it. Everyone else is getting rich. I'm not. So, although ended up coming back to bite him. The other thing that's important are the jet skis. So you don't actually have to swim out. You tend to go on a jet ski. And in the book, I describe how they're a lot like options in that they are insurance in a lot of ways, and that they're there to rescue you if something goes wrong.
Mhm.
But they also can be, initially, that's why they were used in surfing. But then people realized that you could use a jet ski to get on a bigger wave because, bigger waves travel much faster.
Mhm.
So the human body just can't, no matter how good a shape you are, can only paddle so fast. So there was probably a limit about 25-foot waves people could surf. But once you got on a jet ski, you could do like these crazy waves you see in Portugal because the jet ski can push you on the wave and all of a sudden you have all this more force. You can get on now like 60-foot waves. So it is both insurance, but if you flip it around, leverage, which is a lot like options.
The idea of a wave twice the height of my house is terrifying. I
But
think
again, no one invests in stocks. So I mean, we all do things that yeah, we all have our thing.
what is there some survival bias? You're talking to him either because he was really good at risk management in addition to the skill involved in physically surfing, or because he was lucky and his risk management was turned out to be effective. Other people died. Or
Well,
is
I think it's
there
more
anything to that?
selection bias because big wave is a different caliber of surfer.
Yeah.
And you're not going to be in that community unless you've proven yourself in the surfing community already. So, I mean, there is a lot of concern that it is dangerous and get now like not you or I, but someone who's even a mediocre surfer could get on a big wave because of the jet skis.
Yeah.
But, I don't think there's and, people do die a lot. I mean, not a lot, but fairly regularly, but not as much as you think, just because people are surfing the big waves generally, it takes so much skill, it takes so much knowledge to even be there. generally are people who are, as I said, there's some selection bias who opts in to begin with.
But you also have written about financial risk and how it meshes or interacts with the kind of personal risk that you've been talking about. Um, Based on what you've learned from your study of personal risk, are there any broad conclusions that you'd like to share about how to invest money, your own money?
Yeah, I mean, I think the first one is that I think the new book is largely exploring why I don't feel like we're taking enough risk. Uh, and I think a lot of it is like we were saying in the earlier segment that a lot of people just don't feel comfortable because they don't feel knowledgeable. But the good thing about personal finance is I think it's like honestly one of the sort of undersold or less acknowledged great improvements that we've had in the last 50 years or so is how many more people invest in the stock market. I mean, it used to be, 20, 30% of the population. Now it's over 50%. Largely
Well,
because of the 401k and,
yeah,
all
they
the
make you do it. You could completely avoid the stock market in a 401k, but you'd be a fool to do that.
Yeah, and especially with the defaults, most people end up in stocks. But I think it's great. I think it offers people more wealth creation. It offers people more diversification because before people might only own their house as their primary asset, maybe a bank account. And I think in terms of like worrying about things like inequality, I think it speaks to ownership of what makes America great, which are its companies. Um, so I think 50%, well, actually, it's more like 55, maybe inching up to 60 now. It could be even higher. And I think partially because we sort of have this view that lower income people shouldn't be invested in risky assets at all. But feel like that also kind of dooms them to poverty at the same time.
Always be lower income people, right?
Exactly, because you don't get rich without taking some risk unless you inherit your money. Um, but if you look at all these programs for wealth generation of low income people, it's always like, well, if you invest your money, it has to be all in risk-free bonds. So ideally,
Who is promoting that?
well, things like Cory Booker's baby bonds program.
Well,
Or
that's a handout.
yeah, well,
You,
they give you
that,
money
you,
and you're supposed to invest it.
oh,
But
okay.
all
You can
risk-free.
invest it any way you want. Is that the?
Oh, no, actually, it depends on the program. I don't remember the specifics of his program, but I've seen similar like it where it is automatically, or a lot of these sort of state-run retirement programs for lower
Yeah.
income people are in sometimes special securities, but always low risk and low
Okay.
return, obviously. Because I think there's this idea that if you're poor, you can't afford to lose any money, which has some merit. But as we were saying, it's like there is a smart way to invest. It doesn't reduce risk entirely because if you do, you will also not get any return. You can do it in a lower risk way, which is following the principles we do, which are about diversification, hedging, or I wrote a proposal for, I think, the Aspen Security Project of getting lower income people into S&P 500, but with put options. So there's
Yeah.
some insurance involved. I mean, there's all these different things we can do to expose people to risk, but in a lower risk way.
You mean in a fund that internally invests in put options as well as the S&P 500?
Mhm.
So it's like a portfolio insurance fund.
Yeah.
Yeah,
Mhm.
that's a great idea, and I think that more people would invest in the stock market if they could see that there's a floor and that the floor is real. It's not going to
Yeah,
vanish when things get tough like they did in 1987. And
exactly.
nobody knows about 1987 anymore anyway.
I remember. I mean, I was in elementary school, but I remember it was one of the first exposures I had to the stock market. Not that I was invested, but I remember everyone was very upset about it, and that was my first like, wow, market downturn experience.
Well, it could have been the beginning of a Great Depression, and
Mhm.
that's how the 1929 Depression started, was with 2 down days that if you add them together was the same
Yeah.
percentage change as October 19th, 1987. And, it was my father was more upset about it than I was because he
Mhm.
was born in 1915, came of age in the Depression, and it looked very similar, but only for a few days. But then if you go back to 1929, That only looked so bad for a few days. Then the market recovered, and then it went down massively for 3 more years.
Well, we were much worse at risk management then from a government perspective. So
That's right.
we took a bad situation and made it much, much worse. And it seems like, I have a lot of criticisms about government and monetary policy, but I do think on balance, we're much, much, much better than we used to be.
Can you expand on that a little?
Well, as I said, we've, hopefully, we're not going to enact incredibly punishing tariffs. We're not gonna,
I don't think we will either, but the
yeah,
fact that we're talking about them isn't good.
it's not good, but, also, I mean, I've noticed the tone of what we're doing them has changed. Smoot-Hawley was like under this belief of a zero-sum economy where, all of, if trade was all money leaving the country as opposed to now we're talking about tariffs at least as some sort of way to get better deals. I don't know. We'll see. At the very least, I don't think we're talking about Smoot-Hawley tariffs. Monetary policy. We understand now you have to be expansionary. And I think that works. I mean, I'm not a big fan personally of expansionary fiscal policy all the time, but I think it definitely has its role in boosting weak demand from time to time. I'm not really a Keynesian, but I have my moments. I think generally we also have much better social insurance. I think that is also the big thing. We have an unemployment insurance. We've got Medicaid. We've got a million things that just make the world just a lot less risky. And that means if there is a loss of wealth, if there's a loss of jobs, it's just less devastating to the economy.
Well, how do you respond to this critique? Obviously, the government needs to have the freedom to pursue monetary policy and fiscal policy that it thinks are best at the time. But if it always thinks that deficit spending is best, the debt will eventually grow to a size where debt service crowds out other necessary functions of the government. It's beginning to threaten Medicare, Medicaid, Social Security, and the military. And I believe it won't be very long at current rates of growth before the debt is the largest one of those budget items. But what do you
Well,
do? What do you do?
Well, as I said, like I want to be careful of my words, and this is why I said I didn't want to advocate deficit spending expansionary policy because it has its moments of when it's
Yes.
appropriate.
But right when in an emergency you do it.
Exactly. I mean, it troubled me, and I think any financial economist was equally horrified that during the 2010s, when interest rates were at like near lows, everyone was like, "We should be on a spending bonanza." Anyway, the economy was growing fine.
Fine.
Just they're like just because rates are low, and I'm like, when there was all this stuff people were talking about RG and like, well, if interest rates are lower than the growth rate, then like we can spend like crazy. And I was like, well, these are both random variables. And you're talking on debt for decades, and don't even have the sense to issue long-term debt. So this is
Right.
actually, you're pretty much just banking on interest rates staying zero forever, which some people did believe. I
Yeah,
you know,
some people did believe it.
I don't believe any financial condition lasts forever. That's me. But people can argue that. So I think people got confused, and I said, like, I'm in favor of expansionary debt finance expansionary policy. Said if you're staving off a recession and making a recession less bad, but having it just doing it because hey, interest rates are low, less enthusiastic about that. Or I think right now, if you look at the path of the government, it's been in expansion mode since the pandemic, and that might not have been wise.
I think it's been in expansion mode since 2008. In a book that the CFA Institute compiled that I edited, that looked back at the global
Mhm.
financial crisis, I said that you have to look at the personal incentives facing the people making these decisions. When you're a fireman, you benefit from an abundance of fires,
Mhm.
and government officials, kind of operate in quiet obscurity until there's an emergency, and then they run to the rescue and everything. They become rock stars. So they benefit from having things be in an emergency all the time, and that's the way they talk.
Yeah,
It's a
and the government
crisis,
can help you,
crisis.
and I'm the government, so I'm helping you.
Right. That's not
Um,
your money anyway. It's the fellow behind the tree.
Also, I just wrote a column for Bloomberg about this sort of notion of good debt versus bad debt, particularly when it comes to government spending. And they're like, well, if a project works out, then it was good debt. But I mean, you never know that ex ante. Um, you only can say that ex post. And there's also concerns about execution, all of these things. So I argue that it's not good debt versus bad debt. It's good risk management versus bad risk management. And I don't feel like when it comes to the federal debt, we think at all about risk management.
I think that's probably true. They think about getting reelected, getting reappointed, and looking good. And when there's a public opinion poll, how are we doing? But
Yeah,
there are
but
people in
you wonder, does that work? I mean, Biden gave out a lot of money to a lot of people, and they did not think he had a good grip on the economy.
I don't think he did, but I don't want to get into current political problems because we'll never get out of the rabbit hole. But I think it's fair to say that the level of stimulus that has taken place since the pandemic is way out of proportion to any actual emergency.
Yeah.
And once again, the economy is doing fine, but we're spending the deficit is larger than it's ever been in dollars. I'm not sure about relative to GDP. May have been larger during World War II, but not since then. So that's to me that's a serious problem.
Yeah, I think so. And again, it shows no one's thinking about risk management or thinking any project that sounds worth doing is worth doing.
Yeah, that's a good way to put it. Um, there are some other topics in your book in progress in your new book that I think would be fun to discuss. I wonder if you could suggest one because there's a lot of stuff in there, and my own favorites and your favorites may differ. What am I not asking you that you wish I were?
I thought that's a good question.
That's why I asked it.
I don't know. I think feel like your questions are pretty good. Um, I
Well,
mean,
if I can make a confession, I had some questions in mind based on the second book, but they just don't happen to be in front of me right at the moment. I would have to look at the book outline. So rather than do that and interrupt the conversation, why don't you come up with something that really excited you when you were writing the book that isn't financial risk?
well, I mean, what we were just saying, I mean, I think one of the it's 7 myths about risk that I dispel is this idea that the world is riskier than before, and
Oh
that
yeah,
people face.
that's tremendously important.
Yeah, like we were just saying about what life was like in the 30s and why we don't have a Great Depression when the stock market falls now. Um, in all the ways the world is just anyway, it feels precarious in so many ways. Is ultimately, and there's still tail risk, obviously. That the world just typically is a lot safer. Like people don't even compared to say even arguably the 80s, people don't have to worry about a lot of risks that they used to. Um,
That's right. I basically wrote a whole book about it, but not from a risk perspective, but from a wealth perspective.
Mhm.
That we're so much richer than we used to be that we take for granted things that people would have considered unimaginable luxuries only a couple of generations ago. And if you go back farther in history, even the king couldn't call his mother
Mhm.
unless she was in the next room because there were no telephones.
Yeah.
Nathan Meyer Rothschild, the richest man in the world with hundreds of billions in today's money, died at the age of 56 of an infection that could have been cured today with $5 worth of penicillin.
Mhm.
This is less than 200 years ago.
Yeah. Or just indoor plumbing alone. I mean,
Yeah.
whenever I watch like time travel movies, I'm always like, why would you want to go somewhere where they don't have indoor plumbing? Like you've just lost me there.
And why would you want to go to Mars?
Yeah.
There's no air, there's no water, there's no food, there's not much light, and it's hard to get back here if that's what you want or need to do. Now,
Exactly.
I think Elon Musk is one of the world's great entrepreneurs, and So that means he must have some sense. Why does he want to go to Mars? And what do you think of that?
Well, it's interesting, the Silicon Valley guys, because they're really visionaries in ways we're not.
Yeah,
And
I agree.
but I think they also seem excessively concerned with tail risk. And like, have you ever tried to have a conversation with someone, one of them, about Bitcoin or any crypto?
No, because I hate crypto, and I know that if I have a conversation with them about it, I'm going to get eaten alive.
You surprisingly won't. Because for me, the thing that makes so many things don't make no sense, but the most fundamental thing about it that makes no sense to me is, what is its value? And they're like, well, it's an alternative to the dollar in case we debase it. And I was like, all right, so it's a low risk asset. It's like your hedge against financial calamity in the US. I'm like, then why is it so volatile? Why does it have a high beta? Because it's low risk asset shouldn't have
A low beta, yes.
yeah. And then they're like, they can't answer this. And then they just keep telling me that its value is safety. And I think it's because this whole community, as I said, they're very concerned. They like, a lot of them have bunkers in case the whole world falls apart. They're very concerned about tail risk. And I don't know Elon's complete motivation, but I think he said he thinks we should have an alternative to the planet.
Yeah, he
Um,
said that. Other people say it. It's become a meme. We're going to become an interplanetary species because I don't know. We're going to ruin the Earth. No,
yeah.
we're not going to ruin the Earth because it's the only place we can live.
Well, also, like, even if we ruin the Earth, is like Mars going to be better? I mean, it's uninhabitable. Like, even the Earth, slightly less habitable, is better than Mars currently.
Yes, if you think that turning the temperature up 4 degrees is bad, and I think it is bad, how about turning it down 100 degrees?
Yeah. And yeah, I mean, they're all these, like, it's just a strange, or it's like, if we have the technology to go to Mars and make that livable, can't we just make the Earth livable if things go slightly askew?
Well, what I say in my book, and other people have said it, is we've been making the Earth more and more livable
Mhm.
for us. It hasn't necessarily been good for all other species. It's been bad for some, good for some. But if we've been able to do that to the extent that we have, why is today the day that it's going to turn around and go the other way?
Yeah.
And it's not, and we're going to continue to make the Earth more livable for us. But there is a theme throughout history, and you can find it in the ancient Greeks and Romans, medieval times, Shakespeare, and so forth. People recognize there are two themes. One is things were better in the old days, but the other is that things have been getting better, but are about to go to hell in a handbasket starting right now. And what I write that off to is some sort of miswiring in the human brain. But because we seem to pass it down to our children, inherited from our
Well,
ancestors, and it never goes away.
I feel like, it's maybe programmed in our DNA. I mean, because people really did live with constant existential risk for most of human history. So
Yeah.
maybe it's just
So you think it's right to have that
no,
concern,
I don't think it's rational, but I think there's a reason why we do that.
but it was right for a long time in the years where our brains evolved. And
It,
now we've made it not right because of material and economic progress. It's like,
yeah.
kind of where you're
I
going.
mean, I think this is why people also on both political parties kept insisting that this election was so existential. I think saying that we live with existential risk makes people feel alive. We don't mostly. I mean, so there's no risk. Bad things could happen. There's nuclear weapons. There's a lot of uncertainty in the world. But like, I think feeling like existential risk at our door makes us feel alive. Um,
Oh, I know. And the richer people get, and I don't mean like richer like Bill Gates, but as you move off the floor of meeting your basic needs and into having some leisure time and leisure money, people do risky things for fun,
yeah.
and it is fun.
Mhm.
And yet, if you take that and try to apply it, and let's do that in the next 5 minutes. to your financial life, because, the CFA Institute Research Foundation is a financial institution, what you get is something that looks like a Markowitz optimization curve.
Mhm.
You should take risk, but only up to the point where the payoff is enough or more than enough to offset the risk.
Yeah.
Yeah. Do you think about living your life that way? Or do you just think about allocating your financial assets that way?
I mean, I said, like, my financial portfolio is pretty boring. I said I'm just in a bunch of index funds. The most
Mm.
wild thing I do is some emerging market stuff. I guess, like, in some ways, my career is riskier. Like, I didn't become a professor or work for the government,
Right.
and instead I have this sort of weird economics job. Um, so I guess I've taken some risk there, although it doesn't feel like it. In some ways, I feel like
It's because you're succeeding, Allison.
yeah.
Suppose you didn't, then you'd have to go back to the government
Mhm.
and get a job now that you might have taken when you were 26. There's,
I'm not sure they would have me at this stage. I feel like I'm not good, like, I'm not a good team player or something.
I think I could find that in my HR reports. To go back when I worked for large organizations, that they didn't know what they got. So I think, your career and mine have some things in common, but I don't feel like I'm much of a risk taker, really. I
I don't think I am either. But, some people would say we are. I mean, because we've done some unconventional things.
Well, and I didn't get an MBA and then try to get a job with Goldman Sachs, and failing that, have it be the Bank of America. I did a lot of weird stuff I won't get into because this is supposed to be about you.
Hmm?
But it it's I don't think it's because I wanted to take risk. I think it's because I couldn't do anything else.
Yeah, I mean,
That may be what motivates people to take unusual risks.
exactly. Like, I mean, these surfers or tightrope walkers that I said have interviewed for books, it's like they don't think of themselves as risk takers. This is just what they have to be doing.
Yeah, yeah. Neil Young was interviewed recently, and if you just go to YouTube and Google Neil Young interview, he was asked, what were you thinking when you were 15 and you basically did what was necessary to become a rock star? And he said, I wasn't thinking. He said, I couldn't do anything else. And, if you kind of look at him, you can see that he can't do anything else. He
Yeah.
wouldn't have made a good cost accountant. He wouldn't have made a good middle manager at a Target. He had to be a rock star or maybe an actor, or maybe some kind of an inventor. He's just out there. Well, do you think that the successful risk takers have a tend to be Neil Young, tend to have a personality like him, where he's just too far out there to fit into any non-risk uh, profile, not into an organization where where the risk is minimized?
Well, how do we define successful risk taker? Or, like, what's a bad risk taker? Is it someone who takes risks and they go poorly? Or is it someone who just avoids risk altogether?
Those are two different kinds.
Yeah, but they're both, I guess, a good risk taker is people in neither of those categories.
That's what I've. That's a good way to put what I just said, but you don't have to agree with it. What is a good risk taker?
Well, I don't know. I mean, this is actually something we're exploring. I guess it is someone who, when they take risks, on average, they do well, um, and or they don't avoid risk altogether. They take risks, and on average, they go well.
Yeah, but I think that the simple answer is, in that case, the best one.
Yeah.
You go ahead. I was
Although,
going to start to wrap up, but if you have any thoughts that belong in a wrap up, this would be the time.
I mean, by that argument, though, suppose we got MBAs and worked at Goldman Sachs, we'd probably have more money than we do now.
Yeah,
That would have that been less risky or more risky, but it would have had a higher payoff. I think with actually less risk, but less psychic benefit.
well, I think that there's a period in your life, usually when you're young, when you want to work for Goldman Sachs because you just might get rich quick and leave.
Mhm.
And it is possible. I mean, if you think of us having an 8-figure balance sheet as rich, and I do, it is possible to do that in an institution of that kind. And what have you lost? You've lost the opportunity to work for Bank of America instead for a much lower paycheck doing fairly similar work. So I don't think you have to be way out there on the risk curve to take that risk.
Mhm.
But some of if you're a founder, uh, if you're in, let's say, my field, and you start a money management firm when you get tired of being underpaid by the one you're working for, that's serious risk. You can go broke.
Mhm.
And the good risk takers, I think, are the ones that think things out in advance enough that they don't go broke, but thrive. And you don't have to get uh, a large fortune, but you have to get enough satisfaction out of what you did that you don't spend your life thinking I should have taken the other path.
Yeah, and that's why I'd argue even good risk takers sometimes have a lot of risks not work out. I mean, I think a lot of people, might start a business that doesn't work out, but they found it satisfying enough that and maybe they did manage risk well, but we're just unlucky. It happens.
Well, I want to thank you for your generous gift of time to our audience, which is the general public. Everyone can watch this for free. And the CFA Institute Research Foundation thanks you. Uh, this is so much fun. Let's keep this going in some
I
way.
love that. Thank you.
Maybe we can do something in the future.
I love that.
So I'd like to thank Allison Schrager, author of books on personal and financial risk, and an economist of truly unusual gifts. To help talk to you again soon.
For more information, please visit rpc.cfainstitute.org/research-foundation.